Hello everyone. Hello everyone. I'm Advocate Sanjana Ma'am. Welcome you all to JIIB Prep. In today's session, we will start with Unit 14, Investment Management Module D. What is investment management? Investment management. Just a Investment management basically it is a professional management of various financial assets such as share, bond, mutual fund, real estate, and other investment instruments to achieve the specific financial goal of an investor. So so this is investment management. Just to achieve the specific financial goal of the investor, basically investment management are the professional management of the various assets such as share, bond, venture, just to achieve the specific goal of the investor. This is investment management. Okay, what are the important topics in investment management? Investment management element, basics, steps, investment banking, difference between management and investment banking, portfolio management, objective, key elements of portfolio management. What is the difference between portfolio management and investment banking? Difference between portfolio management and mutual fund. Advantages and steps of portfolio management. These are some of the important topics of investment management. Okay, next, what is investment? Investment basically means we are giving committing the money with the expected earning for the future return. Investment is like equity, debt, mutual fund, real estate. All this is a kind of investment. Okay, to get the future gain or to generate the income in the future, we are doing the investment in present. Okay, next, four pillars of investment: return, risk, safety, and liquidity. These are the four main pillars of the investment. Return is basically profit earned by, like, basically it is profit earned from this investment through interest or dividend or capital gain. All this is under return. So it is basically return is the profit earned from the investment. Okay, so basically investor aim is to maximize the return while reducing the risk under its control. So maximize the return and reduce the risk. Risk. Risk is like every investment carries some level of risk. High return, high risk. So it is saying that high return come with the high risk. So it's like every investment there is some level of risk. So this is it. Now basically goal of the risk is to understand and manage the risk according to your comfort level. Safety. Safety is basically guaranteeing the return of the original principal without loss at maturity. Safety is like we will guarantee get the return, guarantee get the return of the original principal without the loss of maturity. This is safety. Liquidity. Liquidity means how quickly an investment can be converted, like how quickly an investment can be converted into cash without any loss. Okay, without any loss of value. So how quickly it can be done. This is liquidity. And liquidity is basically important for emergency need and flexibility. So these are the four pillars: return, risk, liquidity, and risk, safety, and liquidity. Okay, these are the important pillars of investment. Okay, basic investment management. I have told you what is investment management. It's a process of investing just to reach the specific goal of the investor. Okay. Basic of investment management. What are the basic of investment management? Investment management is the process of planning the investment, selecting the asset, and managing the portfolio. It's basically setting the objective, asset allocation, portfolio construction, risk management, performance evaluation, rebalancing. These are the basics of investment management. What the objective? Maximize the return, minimize the risk, or ensure the liquidity. It is the objective of the investment management, whether to maximize the return, minimize the risk, and ensure liquidity. Process of investment management. Firstly, investment management is firstly we set the goal. Setting the investment objective, whether the objective is to maximize the return, minimize the risk, or to increase the liquidity. Basically, in the first stage, we will identify the financial goal. Then define the risk tolerance, return expectation, and time horizon. All this is under step one, that is deciding the goal. After we decide the goal, then we analyze the security, that whether it should be fundamental or technical analysis to find under or overpriced assets. So after decision of goal, we will analyze the security. That is basically selection of security, choosing a specific security with each asset class. Okay, like for example, selecting particular stock and bond or future fund. This is an example of analyzing the security. Okay, construct portfolio. Step 3, constructing portfolio means combines like is basically combining selected security into diverse portfolio. It is constructing a portfolio. It's basically constructing portfolio aim is to reduce the risk and optimize the return. Okay, then fourth step is evaluating the performance. Evaluating the performance means what we actually doing and like what the actual return and what we actually expected when we are targeting the goal, when we are deciding the goal, what we actually expected and what we actually getting, what the actual return is right now. So basically it is the evaluation of performance. Then a revised portfolio. Revised portfolio is basically, you can say, rebalancing or revised portfolio. Basically adjust portfolio based on the, it is adjusting the portfolio based on the market change, risk level change, or investor goal change. If there is any change by the investor goal or market change or risk level change, then we will adjust the portfolio according to that. And it means we will sell the underperforming asset and buy the better one which are like properly performing. So this is the process of investment management: deciding the goal, analyzing the security, constructing the portfolio, evaluating the performance, then revise the portfolio. Okay. Okay. What is the difference between portfolio management and investment banking? What is investment banking? Basically, investment banking is a specialized division of banking system. Yeah, just a second. So, what is investment banking basically? Investment banking is a specialized division of banking that help the companies, government, or financial bodies to raise the capital to provide financial advisory or services and like and facilitate large financial transaction, much like as much as merger and acquisition. Okay, basically investment banking is like objective is to raise the capital and provide corporate advisory such as merger and acquisition. It's like it is for the large financial transaction that are such as merger and acquisition. Okay, and what is like portfolio management? It is objective is to like minimize the risk. Its size is like small, maximize the return and minimize the risk. So objective of portfolio management is to maximize the return and minimize the risk. And what do you mean by portfolio management? Portfolio management is the process of selecting, combination, monitoring, and adjusting all type of investments such as share, bond, mutual fund, and other investment instrument, basically to achieve investor financial goal while balancing the risk and return. Its motive is also to achieve the financial goal of an investor, but by keeping the balance between return and risk. So it is a combination of selecting, monitoring, combining all the investment products just to reach the specific goal of the investor with keeping a balance between return and risk. This is portfolio management. Okay. Clients are individual HNA, people with high net worth value, institution or investment banking के clients हैं. Corporate, government. Nature of work of portfolio management is continuous management, while investment banking is transaction based. Time horizon is long term in portfolio management, while it's short term in banking. Revenue source is management fees. In investment banking, it is advisory fee. Example of the work are portfolio creation or rebalancing. Investment banking examples are IPOs, merger and acquisition. So this is different between portfolio management and investment banking. As I told you, what is portfolio management? Portfolio management is the process of selecting, combining, adjusting all the investment instrument like share, bonds, the mutual fund, just to achieve investor specific goal while keeping a balance between risk and return. This is portfolio management. And what is the objective of this portfolio management? The objective is to ensure capital safety, maximize the return for the investor, minimize the risk through diversification, achieve financial goal of the investor, balance between risk and return, provide regular income, maintain liquidity for cash need. So these are the objective of this portfolio management. That is the reason we should opt portfolio management as investors seeking multi assets exposure but lacking total process knowledge, understanding how market force influence return, individual lacking time in tracking the rebalancing between or rebalance the portfolio. This is the reason why we should opt the portfolio management, as it's optimize the risk, option allocation, flexible holding, capital appreciation, maximize the return. As I already told you, these are the objective of portfolio management. Okay. What are the key elements of portfolio management? This is important. Asset allocation, diversification, rebalancing. Asset allocation, basically distributing fund among different distributing fund among different asset classes like bond, mutual fund, shares, dividing the fund into different asset classes. This is most important element for risk return balance. So this keeps the balance between risk and return. So this is most important in KL, as it keeps the balance between risk and return. Then diversification. Diversification basically mean investing in different securities and sectors. Not investing in particular one security, investing in different security and sector, which will reduce the overall portfolio risk. Okay. It will reduce the overall portfolio risk because it is investing in different type of securities and sectors. Portfolio revision, or we can say rebalancing, basically adjusting portfolio according to the market changes. As per the market changes, as per the market requirement, we will adjust the portfolios according to the market changes and the market requirement. Selling, basically selling the unperforming asset and buying or adding the asset which are better one or which are like performing ones. So this is making the rebalance. Selling the asset which are underperformance and which are like unperforming, and buying asset which are better ones. So in this way, we are rebalancing. These are key elements of portfolio management: asset allocation, diversification, and rebalancing. Ten major roles of portfolio management. It is divided into three phases: strategy phase, execution phase, and the management phase. Strategy phase, we have client profiling, setting objective, asset allocation. In executive phase, we have security selection, portfolio construction, and management phase, we have risk management, continuous monitoring, rebalancing, advisory and report. This we have basically four stage: strategy phase, execution phase, management phase, and client phase. And advisory and reporting and tenth is ensuring complaints. This is a client phase. Strategy, execution, management, client. So these are the 10 major roles which is divided into four phases. Client profiling, basically portfolio management, study the client, their income, their age, their profession, their financial goal. According to that, the client will divide basically. Because because like young investor will prefer equity and high growth, while retired person may prefer safe investment. Just he can like she should have some income at the retirement age. But the young investor want growth. So that's why the proper client profiling, proper analyzation of profiling is very important topic for, it's very important point while the time of portfolio manager. Then after client profiling, we settle the objective, that investment goal are decided, like whether client goal is tax saving, wealth creation, retirement planning. So after client profiling, we will set the objective. Then after setting the objective, that is asset allocation, dividing the assets in different classes like equity, debt, share, gold, real estate. Its purpose is to reduce the risk and improve the return. Then, second phase is execution phase, in which we have security selection and portfolio construction. Security selection. Security selection is basically managers select a specific security such as bond, share, ETF. All these are selected by the manager. Then we have port, uh, portfolio construction, like how like manager will select. Basically manager selection depends upon the risk, return potential, and market condition of the, like how basically it also, we can say that it is dependent on the client's profiling basically. Portfolio construction, portfolio collection is construction basically mean um, selected investment are combined into balanced portfolio. What is the investment we selected, it will combine into balanced portfolio. Like manager will ensure proper liquidity, proper diversification should be there. This is all under the portfolio construction. Then the third phase is management phase, in which we have risk management, continuous monitoring, and rebalancing. Risk management, the risk should be minimized, do such thing which will minimize the risk. And managers should control the investment risk using diversification, balancing. Its aim should be protect the portfolio from heavy losses. Then, continuous monitoring is required by the manager to track the economical condition, interest rate, mutual trend, market trend. Sorry. So all this thing is done by manager through continuous monitoring. Then, rebalancing. There should be over time, like asset allocation may be changed. So to keep the rebalance, we have to sell the unperforming asset, and instead of that its place we have to buy the asset which are better one. So this is maintaining rebalancing. Then the fourth phase is basically advisory and reporting and ensuring complainant. Fourth phase is client phase basically. Advisory and reporting is done by the portfolio manager on the regular basis. Discuss future strategy with the client, advise client, recommend the client with proper product and services. So there should be a good communication build and trust between the client and the manager. This is about advising and reporting. Ensuring complaint, that manager ensure all the investment should follow proper rules, regulation of RBI and SEBI, tax laws. Everything should be properly known to the investment. Managers should ensure that all rules should be are not avoided and should be under the knowledge of the investor also, just to avoid any legal issue and protect investor interest. Okay, so these are the 10 major roles and it divided into four phases. Okay. What's the difference between PMS and mutual fund? Yeah. What is the difference between PMS and mutual fund? PMS are highly customized to the individual, while mutual fund are limited. Mutual fund is like pooling of fund, while PMS is personalized investment management service to the individual investor. And ownership of securities in case of PMS is investor directly own the shares and security, while in mutual fund investor own under the manager basically. It is through the third person who the mutual fund. Okay. In PMS, there is customization. In mutual fund, it is standardized. Minimum size is 50 lakh as per SEBI under PMS, while in mutual fund, there is no minimum size. Free structure in PMS is profit sharing, while in mutual fund, it is fixed entry and exit expense ratio. So, this is the difference between PMS and mutual fund. Portfolio management process. Portfolio management process. First, we understand the profile, that what is the goal of the investor. It is understand the profile of the customer on the basis of income, goal, risk, and tolerance level, and everything. Whether customer belong to a salary employee or level of income, goal, age, everything we will understand the customer profile, what type of customer he is, and what is like how it perform in the past. Then we set the objective, whether they want short-term goal, long-term goal, short-term target, long-term target, just want to maximize the return, just want to minimize the risk. What is their objective? And according to that, we set the objective. Then there is asset allocation, basically division of asset into different classes. Then there's security selection. Security selection basing choosing specific underlying investment. Then construction of like portfolio, building the diverse portfolio. Then monitoring and review. Monitoring and review are very important as it track the performance and execute the rebalancing, that what should be removed out and what should be taken in the picture. So this is the whole process of rebalancing. This is the process of portfolio management, from understanding the profile to setting the objective, asset allocation, security selection, to construction, to monitoring and review. Okay. Next, what are the advantages of portfolio management? Advantages of portfolio management is professional management, continuous monitoring, risk control, hassle free, flexibility, transparency, high return potential, diversification, customized investment plan, liquidity management, convention for investor, goal oriented investing, regular reporting and advice. All these are the advantages of portfolio management, but these six advantages are the most important advantages of the portfolio management. But we have also many advantages of portfolio management: effective asset allocation, tax efficiency. All these are the advantages of portfolio management. Okay. Professional management, basically investment are managed by the expert with the market knowledge and research skill. So this is professional management. Then continuous monitoring, then real time tracking and adjustment for the continuous monitoring will help in rebalancing what should be keep and what should be removed out. Okay, which asset should be keep in the picture and which asset should be like move out of the picture as they are like underperforming asset or just non-performing asset. Risk control. Risk is reduced through diversification and proper asset allocation. If there is proper diversification and asset allocation, there will be no risk. Basically, risk will be reduced. Hassle free. It is like administrative task and daily update handled by the firm, so it makes the process hassle free. Flexibility. Flexibility. These are flexible at as they can hold up to 100% of cash if the market detected. Okay, transparency. It is provide like transparency of work as it provide transparency of work, like detailed performance reporting is given. So it is providing transparency on working. Okay. Any doubt till here? Evaluate the following statement related to investment and identify which are correct. The inherent uncertainty of return in investment make risk an indispensable characteristics that the investor must qualify to optimize their portfolio. It's correct. Liquidity is solely determined by the marketability of asset, irrespective of transaction cost or time delay involved in converting into a cash. It's incorrect. As liquidity, it's incorrect because as liquidity depends not only on the marketability but also on the ease of transaction cost and time required to convert the investment into cash without loss. So liquidity depends not only on the marketability but also on the also on the ease and transaction cost. Okay. Next question. No, sorry, next step. From economic perspective, investment exclusively refer to the net additional to the physical capital stock, whereas from a financial viewpoint, it encompasses allocation of fund across financial instrument for income or capital gains. Correct. Safety in investment guarantee not only the principal but also the fixed nominal return regardless of market fluctuation or issue defaulter. It's incorrect. Safety implies a return of principal without loss but does not guarantee fixed nominal return regardless of market or credit risk. Okay, does not fix nominal return regardless of market credit. The relationship between risk and expected return is directly proportional. As risk increase, investor rationally demand high return as compensation of bearing uncertainty. It's correct. So which are the correct statement? 1, 3 and 5 are correct. That is option A with the right answer. Okay. Option A is the right answer. Second question. Which of the following statement about investment management and its process are correct? First statement. Management fee for investment portfolio are typically fixed regardless of portfolio size. It is like management fees are usually on sliding scale, depend on the portfolio size. So they are not fixed, they are on the sliding scale depending on the portfolio size. So it's incorrect. Fundamental analysis help in identifying whether the security underpriced or overpriced by assessing its intrinsic value. That's correct. Revision of portfolio is done only when the portfolio has achieved its expected return. It's not correct. As portfolio revision is done when the performance does not meet the objective, not only after achieving the expected return, it is done when the performance reaches the objective. Okay. Okay. Next statement. Investment management include coordination client portfolio with their life goals such as retirement and estate planning. It's correct. So which are the correct option? 2 and 5 are the correct option. That is option C is the right answer. Okay. Consider the following statement about investment banking. Identify which of these statements are true. Investment banking primarily provide retail banking services such as saving account and personal loan. It's correct because investment banking do not provide retail banking services. It's incorrect. Underwriting new debt equity security is a key function of investment bank. It's correct. Investment banking division of bank typically offer full range of services including asset management and retail banking. It's correct. As IBD offers limited services like underwriting and M&A, merger and acquisition advisory, not the full spectrum. So basically, IBD does not serve the full spectrum. It is provide services like underwriting and merger and acquisition advisory. Investment bank assists client by advising on merger and acquisition. Read the question. Okay. Consider the following statement regarding full service investment bank and underwriting process. Which of the option correctly defines the true statement? Under the firm commitment underwriting, the investment bank absorbs the risk of unsold security by purchasing the entire issue before resale to the investor. Yes, correct. The best effort underwriting, the underwriter may cancel the issue entirely if sufficient investor interest is not generated. It's incorrect because in the best efforts of underwriting, the underwriter sell as much as possible but does not cancel the issue of full subscription. It is not achieved. Okay, the cancellation to issue the full subscription is not achieved. The best effort of underwriting is the underwriter sell the as much possible but does not. Okay, it's incorrect. The book building process involve institutional investor place bid with price range and help to determine the final official price. So basically, it's a correct statement. Statement 4 is right. All or none underwriting ensure the issue receive fund even only partial subscription on the securities achieved at the offering price. It's incorrect as all or none understanding requires the entire issue to be sold at the offering price. Otherwise, the deal called off and the issue receive no fund. So it is not like receive fund even on the partial subscription. No, it is on entire issue, not on the partial issue. So it's incorrect. So which are the correct statement? 1 and 4. 1 and 4 are the correct statement. In this also we have to tell the true statement. That is answer B is the right answer. Option B is the right answer. Which of the following statement are true regarding the organization structure and function of investment banking? The front office is responsible for generating revenue through functions like investment banking, sales and trading and research is correct. The middle office is primarily responsible for managing the customer relationship and executing the trade. No, it's incorrect. As is like relationship and trade execution are not in the primary role of the middle office. That is more align the work of the front office. This is more the primary work of the front office, not the middle office. Okay, so it's incorrect. The bank officer support front office activity through operational technology. It's correct. Yeah. Risk management, compliance, and financial control fall under the middle office. Yes, correct. The research department in the front office issue report on companies and industries. Correct. The back office involved making capital rising decision and underwriting security. It's incorrect. As underwriting security and capital decision are the work of front office activity, not the back office. So this is also incorrect. So we have to tell the true statement. That which are true statement? 1, 3 and 4. 1, 3 and 4 and 5. That means option A is the right answer. Okay. Next question. Consider the following statement regarding the portfolio management. Portfolio management always guarantee maximum return irrespective of market condition. It's incorrect. Portfolio management always not like management cannot guarantee maximize the return. It cannot guarantee maximize return in all the market condition. It basically its aim is to maximize the return. But it cannot guarantee the maximum return. A portfolio manager provides small investment plan to the client with similar income level. So basically, it means that no client are treated in the same way because portfolio management provide tailored product as per the client's requirement and their need. Okay. One of the objective of portfolio management is to provide efficiency and diversification of investors holding. Yes, correct. Portfolio management involves evaluating trade-off between risk and return across various asset classes like equity, debt, and commodities. It's correct. Portfolio management is beneficial for investment who lacks time or market knowledge to track the rebellions in their own investment. Yes, correct. So, which are the correct answer? Option statement 3, 4, 5 is the correct statement. That is option C is the right answer. Option D. I thought option D is the right answer. Okay. Which the following statement about elements of portfolio management are correct? Asset allocation help in balancing the risk and return by maximize the different type of investment. Yes. Diversification aim to spread risk within and across the asset classes. Yes. Rebalancing involves changing the original asset and mix permanently to chase the high return. No, it is not rebalancing. Rebalancing basically means to restore the original asset mix. It does not involve permanent changes to the chase the return. So it's incorrect. Conservative investors tend to allocate more towards volatile assets. It's incorrect. As conservative investors prefer stable asset, not the volatile asset. They prefer stable asset. Rebalancing helps maintaining the origin risk and return profile of the portfolio. Is correct. So we have to tell the correct statement. So which are the correct statement? 1, 2, and 5. That is option A is the right answer. Okay, option is the right answer. Read the following statement regarding the portfolio management, investment banking. Identify which are true. Investment banking primarily manage client existing wealth to generate return. No. Investment banking purpose is to raise the capital. Does not manage the wealth. Its primary goal is to raise the capital. Portfolio management is tailored especially for clients who want to raise the capital. No. The role of investment banking, it is not the role of portfolio management. It is what investment banking do. Portfolio management clients already have funds which are then managed by the professionals. Yes, correct. Investment banking consider the sell side of finance. Yes. Investment policy statement is created in portfolio management to match the investment strategy with the clients. Is correct. So we have to tell the true statement. 3, 4, 5 are the true statement. That is option C is the right answer. Okay. Option C. Do this question through the PDF. Download the PDF from the description. Next unit. Next unit, that is text plan. Quite an important unit. Okay. What is text planning? Basically, text planning is a process of organizing the individual or organizational financial affairs in a way that it will reduce the tax liability, but in a legal way, by using like proper exemption, rebates, and relief provided under the tax law. It is not you are like maintaining or organizing to reduce, doing things to reduce the tax liability in an illegal way. Use reducing the tax liability in the legal way. It is all about tax planning. Okay. Taxation, classification, financial year, asset, assessment year, previous year, residential status of income tax slabs, investment product, capital gain tax. All these are some of the important topics of Unit 25. What are well, there are two type of tax: direct tax or indirect tax. What do you mean by direct tax? Direct tax is where there is the like burden of tax cannot be shifted. It is directly, basically, it is directly paid to the government of India. So in this indirect tax, the burden of tax cannot be shifted to one from one person to the another person. It is paid directly to the government of India. Burden cannot be transferred, as I told you, based on the income profile or wealth of a person. Example of direct tax is income tax, corporate tax. All these are example of the direct tax. It is an important point of direct tax that it cannot be transferred. Indirect tax basically, it is like in this burden can be transferred from like one person to another person. It is basically consume like merchant pay tax to the government, take from the consumer, then it pays to the government. So basically indirect tax is a tax collected by intermediary. Intermediary is basically seller, service provider. It is from collected from the consumer and paid to the consumer. It in this the burden can be shifted from one person to another. Example GST, which is applying in India from July 1st, 2017. Okay, it's important by the told you direct tax can never be shifted from one person to another. The indirect tax are not imposed on income. Direct tax cannot be shifted and indirect tax are imposed on the income. Okay, earning versus evaluation. Financial year, assessment year. Financial year start from 1st April and end on 31st March. So year is the year in which the income is earned and recorded. And assessment year is the year in which the income earned, what the income earned in the previous year, that is financial year, it is being evaluated. So in the assessment year, the income earned in financial year is being assessed and evaluated. So this is financial year and assessment year. What is previous year? Previous year is the year before assessment year. That is financial year only. So if we are in the assessment year, we will say previous year to the financial year. Okay. It is also a 12-month period, but after the financial year. After completion of financial year, that means it start from financial year completes on 31st March. It will start from 1st. Then it was from April only. April, March, April. Then it will end on March. Okay. Residential status for income tax. As per income tax set, individual tax assets may be classified as a resident, not ordinary resident, a non-resident. Taxability will differ depending upon the respective category of the individual, whether he's a resident or resident of what, resident and not resident, or a non-resident. Depending on the individual category, the taxability will depend. Okay. Though the residential status of person is very important case of income tax. Don't confuse the resident status of income tax with the individual citizenship in India. Individual may be a citizen of the country but will be considered non-resident as per the tax guideline and vice versa. If so, basically, residency state income tax is in different way. Is a resident, or it is he is a resident or resident, not ordinary resident or non-resident. On the basis of it, its tax liability will depend. 5 pillars of income: salary, house property, business and profession, capital gain, and other sources. Salary. Salary basically income earned by employee from the employer in the base of salary, bonus, pension, allowance. This is the basically income from salary is the income earned by employee from the employer. So salary is not included in the completion. Okay. Income from house property. Income from house property basically income earning from owning or renting the property. Example, rent from house or building is the income from house property. Then income from business and professional. Income from business and professional, like income generated by lawyer or advocate, lawyer or doctor, architect. All these are income generated from the business or profession. Capital gain. Capital gain is the income earned from sale of a capital set. What is a capital gain? Capital gain is basically sale price minus purchasing amount. So capital gain is the gain in which we sell the product more than in more price than what it is for bought. Basically, we I bought a watch for 20,000, but later on I sold the watch for 25,000. The 5,000 is my capital gain. Okay. So capital gain is when we sell the product, when we sold the product more than its purchasing price. Other sources. Income from other sources, like income covered under, if income is not covered under this four head, then all the then that type of income will covered will under the head of income from other sources, like lottery winning, gift receipts. All these are income from other sources. So what are the 5 pillars of income? Income from salary, income from house property, income from business and profession, income from capital gain, and income from other sources. Okay. So basically, I've already told you what is capital gain. Capital gain is of two types: short-term capital gain, long-term capital gain. Okay. So basically, short-term capital gain is like gain from asset held for a short period before sale. It is like gain before, like it is for a short period before sale. How it is calculated? Full value consideration minus expenses incurred for such transfer minus cost of acquisition minus cost of improvement. If, for example, a share or equity mutual fund is less than 12 months, suppose a person buy a share of 1 lakh and sell them after 8 months for 1 lakh 30,000. So short term capital gain will be 1 lakh 30,000 minus 1 lakh, that is 30,000. So this is a short term capital gain. What is long term capital gain? Long term capital gain is gain from asset held for like long period. It is like gain for a like very long period. Like a share of mutual fund like more than 12 months, property more than 24 months. So it is long term capital gain. For example, purchase price of share is 50,000. Where should I write? So yeah, share purchase for 50,000 but was sold for 70,000. So 70,000 minus 50,000, it is 20,000. This is long term capital gain. Okay. Section 80C, deduction on investment. Basically, deduction of investment as per section 80C is like uh, deduction from taxable income for certain eligible investment and expenses made by the individual or HUF. What certain expenses made by individual HUF which will like deducted from the taxable income. Okay. Taxpayer to claim the deduction of investment up to 1.5 lakh annually. Its limit is 1.5 lakh annually. Some of the popular investment options under Section 80C include public provident fund, unit link insurance plan, tax saving fixed deposit, employee provident fund, national savings certificate, post office tax saving scheme. All these are the some of the important investment options under Section 80C. Okay. Public Provident Fund offers tax-free return and qualified tax deduction. Unit-linked insurance plan, basically it's combination of investment and insurance with the premium paid is eligible for tax deduction. Tax saving and fixed deposit, it is in basically FD in tax saving of FD we have lock-in period of 5 years that qualify the tax benefit. Employee Provident Fund, contribution made to EPF account and by employees and employees are eligible for deduction. National Savings Certificate, government saving instrument with the fixed tenure, the investment amount qualified for deduction. Post Office Tax Saving Scheme, various scheme offered by Indian Post such as Post Office Time Deposit, which are eligible for deduction. So these are the like deduction and as per the section T, the various income tax saving scheme are available to help the individual to reduce their taxable income and its limit is up to investment up to 1.5 lakhs. Okay, next. Section 115 BAC, new versus old. New tax regime versus old tax regime. So, Section 115 BAC introduced the new tax regime in India, offering lower tax rate with the fewer deduction and exemption. So, it basically it was introduced which as it offer lower tax rates with the fewer deduction and exemption. What's the difference between you can say the old regime and new regime of old tax regime and new tax regime? In old tax regime, basically, they have higher tax rates and allow many deduction and exemption. Like popular deduction is available in like old regime is section 80C, section 80D, HRA, LTA, etc. It is allowed to specially able transport, HR exemption, all these are allowed in old design. While and it is suitable for like people who invest heavily and claim deduction. While new design, which have lower rate but relevance in most exemption, most deduction and exemption are not allowed. Mostly in this all the exemption and deduction are allowed. In this, it mostly it is not allowed. Special tax calculation, lower rate from many income asset, not allow section 80C, not allow HR exemption, but specially able transport is allowed under this section, under this section of 115 BAC. It is the key exam exception. Okay. Section 80D basically provide medical insurance for senior citizen can be claimed up to 1 lakh and it is allowed in old design. Senior citizen with only pension and interest income are exempted from filling return entity. Okay, so they are exempted from filling the return entity entirely. Okay. The mechanics of will: instrument, executor, strategic use. The strategic instrument. A will does not require stamp paper. It can be made legally on a legally valid on the plain paper also. For making the will, we do not require stamp paper. Just on a paper, we can make the will. Registration is optional but recommended for the safety purpose. Like, registration is necessary so that no one can nullify the or fabricate the will basically. Executor is the person appointed to carry out the will process without, like, basically wishes without mentioning in the will. So executor basically is a person appointed to conduct the will process without thinking about the wishes, without mentioning the wishes of the particular person or wishes of the family. Okay, so what are the duties of the executor? Okay, sorry. Basically, executor is appointed just to carry out the wishes mentioned in the will, and its work is to distribute the asset, manage the estate matter, play the liabilities. So all these are the work of the executor. Then strategic use. Strategic use basically mean a will can help to create or continue a Hindu undivided family. We can create or continue, if we are already having, continue the Hindu undivided family, useful for family tax planning. Because of will, there will be no family dispute, as it avoid family dispute. HUF gets separate basic exemption limit under income tax. Trust note basically discretionary trust is created upon a will, not always tax the maximum margin. Certain exception exist for trust note under section 164 of income tax. Is anyone having any doubt in this unit? Okay, let's do some question then. Which of the following statement are true about taxation in India? Taxation in India are true. We have to tell the true statement. So which are the true statement? Direct tax can be shifted from one person to another person. No. Direct tax cannot be shifted from one person to another person. It is indirect tax, not the direct tax. Corporate tax is a type of direct tax imposed on companies' profile. Yes. Corporate tax is a type of direct tax. GST replaced all forms of indirect tax such as service tax, and VAT from July 1st, 2017. Yes. Indirect tax imposed directly on income or earned by an individual. No, indirect tax cannot imposed on income. Cannot. The central and state government in India plays a significant role in determining the taxes. Yes, correct. So which have the true statement? 2, 3, and 5 are true. That is option B is the right answer. Okay. Option B is the right answer. Next, consider the following statement regarding financial year and assessment year. Financial year and assessment year. Financial year is the year in which the income is earned. Yes, it is the year in which income is earned. Assessment is the year is the same as the financial year for taxation purpose. No, assessment year is the year in which the income is evaluated and assessed. Is what income is the the income which is earned in financial year is being evaluated and assessed in the assessment year, and assessment year is after the financial year. Income earned in financial year is assessed and taxed immediately following the assessment year. Income earned in financial year is assessed and taxed immediately in following the financial assessment year. That's correct. So which are the correct option? 1 and 3 is the correct option. That means option A is the right answer. Give the answer, read the question. Identify which of the following statements are correct regarding the concept of previous year and assessment year under the Income Tax Act 1961. Previous year are always started from 1st April and ends on 31st March, even for newly set up businesses. No, it's incorrect. For newly set up businesses, previous year start from date of setup. It's not necessary. It is from 1st April. Income earned in the previous year is taxed is immediately following the assessment year. Yes, correct. For newly set up business, a previous year begins from the date of setup and ends on 31st March of same financial year. Is correct. Assessment year and previous year are always different without expectation. They are like their expectation where assessment year and previous year may be the same, like section 172, 174, they may be same. So there are some exception where the assessment and previous year are same. In certain cases like shipping income of resident or discounted business income is taxed in same year is it is earned. It's correct. So we have to tell the correct statement. Which are the correct statement? 2, 3 and 5. That means option D is the right answer. Okay. Read the question. Consider the following statement regarding residential status under the Income Tax Act. Statement 1. An individual can be citizen of India and still be considered as a non-resident for income tax purpose. Yes, correct. A person who stayed in India for 150 days in the financial year and 370 days in the preceding 4 years will always be treated as resident. No. 150 days in the year, 370 days in the preceding year does not satisfy either condition of residential status. So it's incorrect. Indian citizen with 20 lakh income excluding foreign income and not no tax liability in any foreign country can be deemed as residents of India. It's an important question. Resident, not ordinary resident, is taxed only on the income earned in India, not on the global income. Yes, it's correct. A non-resident is a taxed on both Indian and foreign income if he is qualified as citizen of India. Non-resident are taxed only on income earned in India, not on the foreign income. So it's incorrect. So which are the correct statement? 1, 3 and 5. 1, 3 and 4. Option A is the right answer. Consider the following statement regarding the important terms under the Income Tax Act 1961. The term assess include a person who is liable to pay a tax or against whom the income tax is proceeding have been initiated. Is correct. A person under section 2 clause 31 include individual, HUF, company, firms only. No, a person under section 22 clause 31 include not just individual, HUF, companies, firm, but also association of person, body of individual, local authorities, and every artificial or judicial person which are not covered elsewhere. It is under the term of person. So it's incorrect. PAN is a 10-digit alphanumeric number mandatory for all the assets for income tax identification. It's correct. TAN is required by those responsible for deduction tax at sources. Yes, correct. TDS ensure tax is collected at the source of income by deductor and deposit to the government. Yes, correct. Which of the above statement are correct? 1, 3, 4, 5 are correct. That is option C is the right answer. Consider the following statement relating to the head of income under the Income Tax Act. Identify which of the statement are correct. Salary paid in advance by employee is included in the computation of total income under the head of incomes from salary. No. Salary paid in advance is not included in the income from salary head. So it's incorrect. Rental income from property owned but not occupied by CC is taxable income from house property. It's true. Salary of a partner paid by a firm is treated as income from salary for tax purpose. No. Salary paid to a partner by a firm is not treated as salary income but it is under profit and gain from business or profession. Capital gain arising from transfer of capital assets are taxed under section 54 of income tax asset. Yes, it is basically capital gain. That's correct. Winning from lotteries is taxable under the head of profit and gain of business profession. No, it's incorrect. It under the head of income from other sources. So it's incorrect. We have to tell the correct statement. Correct statement are two. That is option statement 2 and 4. That means option A is the right answer. Consider the following statement about new income tax regime and its provision. Identify which of these statements are true. So, which are true? Under the new tax regime, taxpayer can claim house rent allowance exemption. False. HRA exemption is not allowed in new tax regime. So, it is incorrect. HRA is not allowed. Cannot. Not. Okay. Senior citizen with only pension and interest income are expected from filing a income tax return. Yes, correct. Section 105 BAC introduced option to pay income tax at lowest rate without most deduction. Yes, correct. Deduction under Section 80C is fully allowed in new tax regime. No, it's incorrect. Most deduction under Section 80C are not allowed in new tax regime because in new tax regime they are like most deduction are not allowed. Transport allowance for specifically able person allowed as deduction under the new tax regime, yet it is allowed. Bank will not deduct tax on senior citizen above 75 years as per section 194P. So it's incorrect as banks still deduct tax on citizen above 75 years as per the rule. So it's incorrect. So which are the correct options? 2, 3 and 5. Option B is the right answer. Do this question through PDF. Let's do this question. Read the following statement about estate planning through will and trust carefully. Identify which of these are correct. Which of them are basically correct. A will must be written on stamp paper to be legally valid. No. It can be written on simple paper also. So it doesn't require proper stamp paper to become it valid. Second statement. An executor appointed under the will is responsible for ensuring the testator's wishes and fulfill. Yes, correct. Income of discretionary trust created by a will is always taxed at the maximum marginal rate under the Income Tax Act. No, income for discretionary trust created by a will not always taxed as the maximum marginal rate. Exception exists under certain condition. That condition is section 164. Okay. Creating HUF through will helps in availing separate exemption limit under income tax. Under income tax, yes, correct. The executor of will continues to be assessed from income tax on estate until the full distribution is complete. Yes, is correct. So, which are basically correct statement? 2, 4, and 5. That is option A is the right answer. Okay. Okay. Before starting the next unit, is anyone having any doubt till here? Unit 26. Other financial service provider by bank. Okay. In this distribution of third party product in retail banking, it is an important topic. Mutual fund businesses, insurance, cross selling, portfolio management services. All these are some of the important topics of other financial service provider by the bank. Okay. Distribution of third party products in retail banking. What it is mean? It means the bank sell the financial product of other companies to its customer and earn commission or fee on that. Basically, yeah, bank sell. Basically, bank sell the product of some third party. ठीक है? Like third party A to its customer, selling his product to his to bank's customer. It is the process of distribution third party. Okay. So it means the bank sell the financial product of other companies to its customer and earn commission or interest on it. Okay, basically commission or fee. For example, third party like distribution to third party is like example a mutual fund, credit card, tax saving product, investment plan. All these are the example of distribution of third party product. Who are the major participant in this distribution of third parties? Bank, third party company, and the customer. Bank, basically bank is in the middle, third party company and the customer taking the product, selling to its customer. So bank is basically act as an intermediary between third party and the customer. Okay. Mechanics of Mechanics and feature of mutual fund. Basically, investor pools their money into a common fund, that is mutual fund. The mutual fund issue units to the investor, that is invest in the security. The fund manager invest money in shares, bond, etc., and then invest in securities like share, bond, debenture, everything. Then NVA will calculate it. Like is NVA is total asset minus liability upon total units. Then investor on return through dividend, capital appreciation. Then investor can redeem the units in open-ended scheme. So it's basically like whole process of mutual fund. Investors came, pool their money. The fund manager will invest their money in different type of debenture, bond, and everything. Then that these are the securities. Then these securities, through these security, will generate return. That return will pass back to the investor. So basically, this is a whole circle thing. What are the key features of mutual fund? Professional management, diversion of risk, liquidity, affordable investment, economic of sale, transparency, variety of scheme like equity, debt, share, hybrid. All these are the features of the mutual fund. Okay. Classifying mutual fund as asset classes. Equity fund or fixed income fund, or like you can say debt fund. Equity fund. Equity fund means invest mainly in shares and stock in which we have high risk and high return, because high return come with the high risk. Suitable for long term investment, and is like example large cap fund or mid cap fund, ELSS fund. All these are example of equity fund. Its target is stock and large capital. Rank is first to 10th by market cap. Objective large term capital growth. That is equity fund invested mainly in share and stock. In fixed income fund, or you can say debt mutual fund, it's in this basically invest is fixed income securities like bond, debt, corporate bonds, or like treasury bills. All these in this basically investment amount is fixed income. Though in this they are less risky compared to equity fund, but suitable for stable income. When we have stable income, it is suitable for that type of debt mutual fund is suitable for suitable income. Okay. Example liquid fund, income fund, or the example of gift fund, or the example of debt fund or fixed income fund. What's the structural type of this debt fund? It is open-ended, interval fund, ELSS, children fund. Open-ended, no special maturity date or liquid. Interval fund, transaction permitted only during predetermined specific period. ELSS offered in Section 80C tax benefit. Basically, Section 80C tax benefit is under this debt mutual fund. Children fund, solution oriented, lock in period at least 5 years or until maturity. What is insurance? Insurance is basically means we are providing premium to the insured person. On that premium amount, the insurer will provide us the security and protection for from a life or health or some type of what, as per the thing what we are taking. Like if we are taking the life insurance taken for the providing financial protection from the risk of death. So basically, insurance is we providing the premium to the insurer. The insurer will provide us the protection, like financial protection in the exchange of their premium. Okay. Life insurance procedure: lump sum on maturity or death. Long term contract provide life cover. Nominee receive claim amount on death. Money fixed payout at interval during term. Full sum assured on death. Pension secured retirement stability also. Types of life insurance are like term insurance, whole life insurance, endorsement policy, money back policy, or unit link insurance plan. All these are type of life insurance. What you meant by general insurance product? General insurance cover risk other than life. It cover every risk other than life, like health insurance, auto insurance, or house insurance, fire insurance, travel insurance. All these are under general insurance, in where the all types of risk cover except the risk of life. Health insurance does not just cover the accident; it also cover the illness. Pradhan Mantri Jeevan Jyoti Bima Yojana. It is an important yojana. It is basically government backed life. It is like life insurance governed by the government scheme, providing covering in case of death. It is covered in the case of death. Covered individual age from 18 to 15, enrolled from 1st June to 31st May annually with auto debt full premium renewal. Benefits: 2 lakh payable on a debt due to any case. Premium of rupees like 436 per annum per member. Termination coverage ends at the age of 55 upon the account closure or due to insufficient balance. Member cannot cover other Pradhan Mantri Awas Yojana with LIC or other company. If you are enrolled and covered under Pradhan Mantri Awas Yojana, it doesn't mean you can run the LIC also. You cannot. You can, if you are enrolled in or covered under Pradhan Mantri Awas Yojana, Pradhan Mantri Jeevan Jyoti Bima Yojana, then you cannot take LIC facilities. Okay. There is also one more scheme, Pradhan Mantri Suraksha Bima Yojana. Pradhan Mantri Suraksha Bima Yojana, it's also basically covered accident insurance scheme. This Pradhan Mantri Jeevan Jyoti Yojana covers like death cover in case of death. It is, and Pradhan Mantri Suraksha Bima Yojana, it is a scheme which covers the accident insurance scheme basically. Its type is like it is eligible to 18 to 70, as Pradhan Mantri Jeevan Jyoti Yojana is eligible from 18 to 50. On Suraksha Bima Yojana is eligible for 18 to 670. It also covers 2 lakh for accident, accidental death or total disability. It covered with the government will provide you 2 lakh if it the due to accident if there is a death or complete disability, and 1 lakh if because of the accident you have the partial disability. Premium of rupees 20 per year is being paid subject to revision. It is renewal every year, and premium will auto debited from your bank account. What is cross selling? Basically, cross selling means selling the additional financial product or services to the existing customer based on their need. What the customer required, or what are the requirement, what are the need, according to that the cross selling basically selling the product and services to the existing customer. The customer is already the part of the bank, selling the product and services to the person. Okay. Example, saving account customer may also be sold credit card, mutual fund, home loan. In it will increase the customer value and the bank profitability. So this is the process of cross selling. Cross selling is beneficial for both. It is beneficial for the customer also, and it is beneficial for the bank also. How it is beneficial for the bank? Because it generate higher fee income, increase profitability bank, help a bank to maintain a long-term relationship with the customer, as if it's cross-selling the product, the customer will buy it. If you have a strong customer loyalty, better customer retention, because attracting the customer is one thing, but retaining the customer is most important thing. Okay. Why it is beneficial for the customer? As it is a one-stop financial solution, it is convenience, better financial planning is provided through cross-selling. Okay. Cost acquisition, that is new customer, but cross selling is for like existing customer, which are like up to 5x cheaper than the attracting new customer. Why cross selling matters? It is matter because it increases the profit, brings the brand loyalty, better CRM, better customer relationship management. Cross selling main focus is of selling additional product to the existing customer, not poaching from the other banks. Okay. Portfolio management, I have already told you what is portfolio management. What are the RBI directives of the required prior RBI approval and SEBI compliance? Fund must be held for minimum 1 year. Fee must be charged independent of portfolio return. PMS fund cannot be used for lending call while. Okay, let's do some question. Consider following statement regarding the mutual fund. Read the question and give me the answer. Mutual fund pools money from many investors and invest in diversified portfolio. It's correct. Investors in mutual fund are called bondholders. No, it's incorrect. The investors in mutual fund are called unit holders, not the bondholders. They are called unit. They are called unit holders, not the bondholders. Asset management companies must register with SEBI. It's correct. Mutual fund units are not liquid and cannot be sold easily. No, mutual fund units are liquid and can be sold in the market. ELS scheme under mutual fund provide tax benefit under section 80C of Income Tax Act 93. That's correct. Which are the correct options? Statement 1, statement 3 and statement 5. 1, 3, 5. That is option B is the right answer. Okay. Next. Identify which of the following statement about mutual fund types classification are correct. Equity fund aim primarily for long-term capital growth. It's correct. Open-ended fund have a specific maturity date and are listed on a stock exchange. No, open-ended fund do not have a maturity date. Closed-ended fund do not. Closed-ended fund do and are listed on the stock exchange. Open-ended fund are not listed in the. Do not have the maturity date basically. Interval fund allow buying and selling of units only during specific period. Yes. Debt scheme primarily invest in share and stock for capital appreciation. No, it's incorrect. Debt scheme invest in debt investment in debt instrument, not in share and stock. It is in debt instrument. SEBI mandate categories of mutual fund scheme into equity, debt, hybrid, solution oriented, and other scheme. Yes. Children fund is a solution oriented scheme with a lock-in period of at least 5 years or till the attain majority. Yes. Large cap companies in rank from first to 100 based on the full market capitalization is correct. Which are the basically correct options? 1, 3, 1, 3, 5, 6, 7. That is option A is the right answer. Do this question from the PDF. This also. Consider the following statement about insurance sector in India. Read the question and give me the answer. Insurance allow transfer of financial risk from insurer to insured. No. The direction is reverse. It is the insured who transfer risk to insurer. It is insured who transfer risk to insurer. Health insurance only covered accident injuries, not illness. It's incorrect. Health insurance also cover illness also. Life insurance include products like endowment policies, term plans, and money back policies. Yes, these are type of life insurance. Pension plan, the type of life insurance product aimed at the retirement planning. It's correct. Deregulation has limited the scope of insurance business in India. It's incorrect. Deregulation expand the insurance market. It is not like limited the scope. It has expand the insurance market. General insurance include property, health, liability insurance. Yes. General insurance include all the risk except the risk of life. So which are the correct statement? 3, 4 and 6 are correct. Option D is the right answer. Okay. Consider the following statement about insurance business by bank as per IRDA license of bank as insurance broker regulation 2023. Statement 1, banks are allowed to undertake the insurance business with the risk participation departmentally. It's incorrect because banks are not allowed to undertake the insurance business with the risk participation departmentally. Okay, statement second. Bank can undertake insurance business with the risk participation only through a subsidiary or joint venture. Yes, correct. A bank must have a minimum net worth of rupees 500 crore after investing in the equity of insurance subsidiary. Yes, correct. Bank must maintain deposit of 50 lakh with a scheduled commercial bank other than itself for the broking license. Yes, correct. Bank can force customer to buy insurance product linked to the other banking product. It's incorrect. Basically, it's incorrect because bank cannot force the customer to buy the insurance linked to another banking product. It cannot force the customer. Employee dealing with insurance broking must be possess qualification as prescribed by IRDA. Yes, correct. Bank acting as an insurance broker departmentally must have a broad approach customer grievance redressal policy. It's correct. So which are basically the correct option? 2, 3, 4, 6, 7. That is option B is the right answer. Do this question through PDF. Read the following statement related to Pradhan Mantri Jeevan Jyoti Bima Yojana and Pradhan Mantri Suraksha Bima Yojana and identify which of them are true. Pradhan Mantri Jeevan Jyoti Bima Yojana offered life insurance cover for death due to any reason. Yes, correct. Second, Pradhan Mantri Suraksha Bima Yojana cover accident, death, and disability only. Yes. Annual premium for Pradhan Mantri Jeevan Jyoti Bima Yojana is rupees 20 per member. No, it is 436. It is rupees 4. And if it's written Pradhan Mantri Suraksha Bima Yojana, then rupees 20 will be the correct answer. The maximum entry age of Pradhan Mantri Jeevan Jyoti Bima Yojana is 50 years, while covered termination at age of 50 years. Correct. Pradhan Mantri Suraksha Bima Yojana provide 2 lakh benefit for total and irrecoverable losses of both the eyes. Yes, correct. Enrollment for both the scheme require auto debit consent by 31st March each year. Yes, correct. If a person hold multiple bank accounts, they can enroll in Pradhan Mantri Jeevan Jyoti Bima Yojana and Pradhan Mantri Suraksha Bima Yojana through each account separately. No. Enrollment is allowed through only one bank account per individual for either scheme. You cannot enroll in both the scheme. You can enroll in either scheme. So option 7 is incorrect. So we have to tell the true statement. So which are true statement? 1, 2, 4, 5, 6. 1, 2, 4, 5, 6. That is option C is the right answer. Do this question from PDF. This is also. Okay. Last unit. Last module of the IIBF. Don't think it is an additional unit, so it is not important. It is also one of the important module of RBWM. And from last few years, we are seeing that questions are coming, some like typical questions are coming from this module. So don't think this module is an additional reading, so we will not study this module. You have to study this module in a proper way. Okay, let's take a 10-minute break. Then we'll start with home loan module E. It's 7:37. We will start at 8:45. Okay, we'll start at 8:50. Oh, 7:50. Sorry. We will start at 7:50. Basically, we'll continue at 7:50. Okay, so let's continue with additional reading material, home loan. Okay, so units 27, lender appraisal procedure. What we mean by lender appraisal procedure? Basically, lender appraisal procedure is a process followed by bank and financial institution to evaluate the borrower before granting them loan. So it is done to evaluate the borrower before granting them loan. Its objective is to assess the credit worthiness of the borrower, repayment capacity of the borrower, or risk involving in the lending process. Appraisal procedure, application form, application received through agent, all loan required documentation, mortgage, monitoring, closure of account, home. All these are some of the important topics of Unit 27. Lender appraisal process, I already told you what is lender appraisal process. A documentary foundation for establishing repayment capacity. First, we have to identify and generally identify and just a second. Yeah. Documentary foundation of establishing and repayment capacity. This block identity and general requirement. First is application form, identity proof, RERA approval. All these are general requirement for lender appraisal process. Okay. Then income verification devices. Income verification is divided into salaried applicant and non-salaried or self-applicant. Application form, basically application form gather the financial data, obligation to check the policy alignment. Identify proof is Aadhaar card, PAN card, voter ID, passport. All these are the identity proof of the borrowers. RERA approval mandatory. RERA approval is mandatory only when the application is like only when there is application. Not it is not mandatory for every single property regardless of the status. It is like, for example, registered real estate project for that thing. RERA is mandatory. Income verification is divided into salaried applicants and non-salaried or self-employed applicants. In case of salaried applicant, two other documents are required, which are required salary certificate or form, plus form 18. And in case of non-salaried and self-employed person, we require two different documents, which is require proof of their business address plus IT assessment order for past 3 years. These are the two different documents which are required by salaried applicant and non-salaried applicant. Rest three document, which is application form, identity proof, RERA approval, is in both the cases. Okay. Document required for home loan. Common documents includes our identity proof like Aadhaar, PAN, address proof, income proof, that is salary slip or ITR, bank statement, property paper. All these are requirements. All these are documents required for home loan. Basically, this help the bank to verify the authority and the repayment capacity of the borrower. Application received through agent. Important topic. Sometimes loan are sourced via broker or direct selling agent. Bank must be careful to avoid misrepresentation or verify the customer detail independently. Okay. Application form in loan process. Basically, it means a loan application from loan application form is a document submitted by borrower requesting for loan fund from a bank or from the financial institution. So this application form is basically a document submitted by borrower to the bank for requesting loan. And in this application form, it will provide with the necessary information like for evaluation the loan request. It will conduct all the necessary information which are required by bank to evaluate the loan request, whether to accept the loan or reject the loan. Content is like name, address, reason. Okay, appraisal process in loan request. What is the appraisal process in loan request? It is also important. This is also important. Appraisal process in loan request basically mean evaluating the borrower's repayment capacity and risk before granting the loan. So in the appraisal process before granting the loan request, basically it's evaluating the repayment capacity of the borrower and what level of risk is arise or there's any risk before granting the loan to a customer or the borrower. RAC, risk asset acceptance criteria, is basically a banking division or a parameter that handles the retail loan and agriculture credit. It focuses on lending to individual or to the farmers. So it's basically a criteria division. It is a department that handles retail loan and agriculture credit. That is risk asset in acceptance criteria. Power of attorney. Before it, there are some functions like function of RAC, that is they handle home loan, vehicle loan, personal loan. Activities under it basically they handle everything for the activities, loan processing, documentation, credit appraisal. All these are done by this risk asset acceptance criteria. Okay, what we meant by power of attorney. Basically, power of attorney is a legal document through which a one person authorize another person to perform on his behalf. So power of attorney, one person authorize another person to perform in his behalf. That is power of attorney. The person who is giving the authority is called principal or the donor, and person who is receiving the authority, who is basically doing on the person's behalf, is the agent or the attorney holder. Okay, so what is the difference between simple mortgage and equitable mortgage? Basically, what is simple mortgage? When the borrowers promise to repay the loan, it is simple mortgage. And if borrowers default, then lender can sell the property through the court action. In this property, possession and ownership remain with the borrowers, but the lender can sell the property through the court action. This is simple mortgage. And what is this equitable mortgage? Equitable mortgage basically deposit of title deed. In this the equitable mortgage, a borrower deposit the original title deed with the help of banker or the lender. No formal registration deed is usually required in the equitable mortgage, and this is commonly used by banks for home loan because it is simple and economical. Okay, so this is different between simple and equitable mortgage. Transfer of position, no transfer of position, no transfer of position. Right to sue for personal liability, yes, yes. Court intervention required for scale, yes, yes. By bank must initiate legal action, yes, subject to surface exception. Registration requirement mandatory in simple mortgage, no requirement of registration. Geographical restriction, there is no geographical restriction in simple mortgage, but in equitable mortgage, it's only specific notified towns like Kolkata, Mumbai, Chennai. Method of creation, simple mortgage registered deed. Equitable mortgage delivers title document to the mortgagee or the agent. Section 50A of Transfer of Property Act, the interest transferred in mortgage can include both present and future liabilities. Okay. Any doubt? Okay. Threat versus shield in mitigating income and source fraud. First, fabricating income document. Basically, it means borrowers submit the fake financial document to get the higher loan. Example, fake income tax return, fake salary slip, fake balance sheet. This is the threat. Their purpose is to get higher income and become eligible for larger loan. And shield to this is basically cross verification of the account, com- uh, comparing with the bank statement, IT assessment verification. All these are the things which are shield to the fabricating income document. Then threat 2 is third party encashment. Third party encashment means loan amount is diverted or encashed by the third party who is unauthorized person or an rage agent. And that basically an example like loan check did issue to the builder but encashed by the another loan check or did issue to the builder but encashed by some other person. Shield toward this is basically direct account credit. Direct account credit, basically bank directly transfer the loan amount to the builder verification or seller confirmation account only after verifying the account details properly. So this is a shield toward third party encashment. Then third threat is forgot the title deed. Forgot title deeds means borrower or a builder submit a fake property document such as fake stamp paper, colored photograph resembling originals. So this is the threat. Forget the title document. So their purpose is to falsely prove their ownership of the property. Shield toward this is basically legal verification, SARFAESI verification. SARFAESI verification, the bank must verify the mortgage through the SARFAESI Act basically. Their purpose is to prevent why this is shield is to prevent the multiple financing and detect the existing charge on the property. Who is the existing owner of the property? Overvaluation of property. Overvaluation of the property is a threat. It means the borrowers or builder club with each other with the value to influence the property and the property valuer artificially. And what the shield toward this? Shield is like basically shield is toward is basically mandatory site visit. Bank official has to visit physically to the inspect the property in a proper way. Local market inquiry. Bank officials should be inquire all this with the local area, with the people of local with the people who are located in that area for sale value, actual condition of the property. So to ensure the correct valuation and avoid the access lending in the case. So these are the threat, and the threat they have the shield also in the mitigation income and sourcing the fraud. Fabricating income document, third party encashment for the title document and overvaluation of the property. Okay, let's do some questions. Read the question. Consider the following statement regarding the loan organization process. Statement 1. During the information acquisition, verification through external agency is mandatory for all types of loan, regardless of ticket size or borrower profile. It's incorrect. While verification through external agency commonly used, it is not mandatory for all types of loan. Bank may be used discretion based or internal policy, borrower type or the loan size. So it is not verified through external agency. So it's incorrect. Second statement, weighted risk based credit scoring is used not only to assess the credit worthiness but also to determine the exact disbursement mode, that is check, account transfer, direct supplier payment. It's incorrect. Weighted risk based credit scoring help to assess the credit worthiness and fix the loan term, but it does not decide the mode of disbursement because disbursement method depends on the nature of the loan and agreed term. So it's incorrect as it cannot determine the exact disbursement mode. A loan can only be disbursed after full compliance with the term and condition of the sanction, and repayment schedule must be provided to the borrower at or before the disbursement. Yes, correct. Correct answer. So, which of the following are the correct statement? Only statement 3 is the correct statement. Then option B is the right answer. Which of the following statement are correct in the context of internal home loan appraisal procedure and required document? The application form serves not only as a data collection tool but also as a legal agreement binding the borrowers to the repayment schedule. It's incorrect. Basically, application form is only collecting information. It is not a legal agreement. So it is only collecting information, not a legal agreement. For non-salary application, both proof of business and address and IT assessment order for the past 3 years must be submitted. Yes, correct. A non-encumbration certificate issued by jurisdiction sub-register officer is different from the search report obtained by the bank advocate through both serve to the confirmed clear title. Yes. The bank must collect RERA approval in all housing loan cases regardless of project status or location. No, it's incorrect because RERA approval is required only where the application, example in the registered real estate project, not in all the cases. So it's incorrect. A legal opinion title should be sought even if the borrower submit a registered sale deed from the government body. It's correct. A valuation report must be comment on the feasibility of construction and demarcation of land boundaries, but the construction plan need not to be engineer approved. It's incorrect because construction plan must be engineer approved for viability and technical correctness. So it is not said it is not for the engineer approved. Construction plan need to be engineer approved. It's incorrect. For existing building flat, the branch must be ascertain the building age, tax status, and confirm the construction approval from the local authority. It's correct. So, which are the correct option? As you have to tell the correct in context of internal whole appraisal. Statement 2, statement 3, statement 7, and 5 is also correct. 2, 3, 5, 7. Option A is the right answer. Okay. Which of the following statement about the loan appraisal process is are correct? The loan appraisal process involve validating the information submitted by the loan application, including the property, details, and financial data. Yeah, it's correct. The loan application must be approved without any check to avoid delay. It's incorrect because loan application must undergo check before approving it. Okay. All mortgage DG required only if the property is registered as a collateral for the loan. Yes, correct. A risk asset acceptance criteria help in setting the standardized guideline for loan acceptance based on the borrower financial profile and property value. Yes. Legal and valuation opinion are optional and not necessary for loan appraisal process. No, as a legal and valuation opinion are crucial for assessing the loan approval for the property and borrower's eligibility. So as these are the not options, they are crucial. So which are basically correct statement? Statement 1, statement 3, statement 4. 1, 3, 4, that is option A is the right answer. Which of the following combination of statement is correct? A fixed rate A fixed rate home loan and floating rate home loan both have the same repayment structure and cannot be differentiated based on the repayment tenure. It's incorrect because fixed rate and floating rate loan have different structures, especially in how the interest rate are applied. So it's incorrect. A home loan moratorium period is capable of 18 when the loan is a property is under construction by reputed building or the government agency, irrespective of the construction phase. Yes, correct. And in case of purchase, it is 3 months. Pre-EMI interest is calculated as simple interest on the total loan amount from the date of first disbursement until the full EMI payment commences. Correct. A borrower must pay EMI payment before receiving the full disbursement amount in case of the loan property purchase from non-reputed development. It's incorrect because pre-EMI interest is payable only on the amount disbursed, not on the total amount, and payments start from the first disbursement. It is only on the amount disbursed, not on the total amount. In case of floating rate loan, the EMI amount remain constant while the loan tenure may either increase or decrease depending on the rate of adjustment is correct. For salaried borrower, the check-off facility requires irrecoverable letter or authority from the employee to deduct the monthly installment from the borrower's salary and remit them into the lender. It's correct. The check-off facility for the borrower employee with the government requires an agreement from the employee, which is not mandatory for private sector employees. Incorrect. Because the check-off facility also required letter of undertaking from the employer for government employee. It is not for private sector employee. So which are correct statement? 2, 3, 5, 6. Option D is the right answer. Which are the following statement? Which of the following statement about loan documentation is correct? Statement A. A letter from borrower a letter from borrower to bank requires to extend their earlier mortgage when mortgage is a second chance. Is correct. Statement 2. A valuation report from engine is not required. How a valuation report from engineer is not required for loan against the property purchased from the government body. It's correct. A no objective certificate from the builder or seller is mandatory for the property purchase under a home loan. It's incorrect because NOC from builder or seller is only needed in the is a basically specific like housing society, not for all the home loan. It is in a specific cases. A legal opinion from bank advocate certify the clear title to the property is only required when the purchasing new properties. It's incorrect because legal opinion is required for both new and old property, not just for new one. It is to confirm the property. It is to confirm the property has a clear title. An indemnity or guarantee may be obtained if the builder has appealed to authorize for regulation and unauthorized construction. Yes, correct. So, which are basically the correct statement 1, 2, and 5. That is option C is the right answer. Which the following statement about the mortgages and related provisions are accurate? Read the question and give me the answer. Under the Transfer of Property Act 1882, a simple registered mortgage allows the mortgagee to sell the mortgage property without the court intervention, provided the property is located in notified town. It's incorrect. While simple registered mortgage allows the mortgagee to sell the property if there is a mortgagor default, it is required court intervention for the sale. There is no contravention. The condition does not apply to the simple registered mortgagee. So it cannot be happen without court intervention. There should be court intervention. So it's incorrect. A mortgage by deposit of title deed may only be created in cities like Kolkata, Mumbai, Chennai, or in other towns specifically notified by the state government, and the mortgagor must deliver the title document to the mortgagee's agent. It's correct. In simple registered mortgage, a mortgager's personal liability to repay the loan is not specified, and the mortgagee can only seek sale of mortgage property if the mortgager fails to pay with the court intervention. It's incorrect. As in the case of simple mortgagee, the mortgager's personal liability to repay the loan is specifically mentioned. It is not specifically, it is specifically mentioned, and the mortgagee can initiate the legal action for the sale property in case of default, but the court intervention is required. Okay, they can do the mortgage can initiate the legal sale, but with the court intervention. So it's also incorrect. In case of an equitable mortgage, the mortgagee parts with the possession of the title deed for a specific purpose, such as examination by the third party. The mortgagee remains valid as long as the mortgagee has a legal understanding with the mortgage. It's correct. Under Section 58A of Transfer of Property Act, the interact transfer in mortgagee can include both present and future liability, but the mortgagee is not required to register the mortgagees in the case of mortgagee by deposit of title deeds. Correct. So we have to tell the accurate, that means correct statement. 2, 4, and 5 are the correct statement. That is option B is the right answer. This question is important. Which the following statement are true regarding the registration of chargeable SSI? Do this question with the PDF. Do this question from the PDF. Identify the correct statement regarding the home loan fraud. We have to tell the correct statement. When you read the question, just mark the whether they're asking the correct statement or incorrect statement. Then it will be easy for you to give the answer. Overvaluation of property is committed in collaboration with builders and valuer to secure high loan amount. It's correct. Forged property documents, including colored photocopies of incumbent certificate, and are difficult to detect from the original ones. Correct. Verification of salary slip with the employer is not necessary for loan approval. It's incorrect because verified salary slip is essential in detecting fraud. Tracking incumbers on property via SARSAI website can help to prevent multiple financial fraud. It's correct. Bank can disburse the loan amount directly to the third party without verifying the Builder's account, no, it's incorrect. Bank should credit the loan amount to the builder account after verifying the detail, because then it can lead to fraud. So it's incorrect. So which are the correct statement? 2, 3, and 4. Sorry, 1, 2, and 4. Option A is the right answer. Because if the bank will just credit the amount without verifying the account of a builder, then it is a threat to the banking system. Okay, I'll do this question from the PDF. Next unit, that is housing finance and tax planning. That is unit A 28. Tax benefit in respect of housing loan. In this, basically, we have home loan. Tax benefits are tax deduction payment, home loan, interest, loan interest, section 24. Tax decision on principal repayment of housing loan, section 80C. Tax decision for the first time home loan buyer, that is section 80A. So these are the tax benefit on the home loan. Section 24 is on loan interest. Section 80C, that is deduction on principal repayment of housing loan, and 80E for the first time home buyer. So section 80C is the principal pillar of the tax benefit. Sorry, tax benefit, home loan tax benefit basically. Section 80C, deduction on principal repayment. Basically, in this it target in this basically we target principal repayment of home loan, in which we have limit of deduction up to 1.5 lakh per financial year, and eligible amount is principal repayment for home loan, stamp duty and registration charges is the eligible amount. Condition, house property should be sold within 5 years from the possession. So in case in this as per this section 5, that house property will not be sold within the 5 years from the possession. Okay. The shared basket is 1.5 lakh limited share basket. They have the public provident fund, national saving certificate, employee provident fund, tax saving fund, tax saving FD, and life insurance premium. All these are the share under the section 80C. Property stated available for both occupied and let out property, and can be claimed for more than one house property. But the condition in this is basically house property should not be sold within 5 years of possession. Section 24B, the interest pillar. This is the principal pillar. This is the interest pillar of tax benefit of home loan. It is on self-acquired property and let-out property. In case of self-acquired property, the deduction is up to 2 lakh per year on interest paid, and in case of let-out property, the entire interest is deducted, subjected to overall loss adjustment claim. So basically, in let-out property, entire interest will be deducted. The core component, relief target interest paid on housing loan. Head of the income is income from house property. Eligible income is deduction can be claimed against income from salary, income from business or profession, income from capital gain or other sources. And maximum limit, as I told you, self-acquired property is 2 lakh per year, and let out property entire amount can be paid. In case of repair, and annual limit is 30,000 only. Documentary requirement, lender must issue a year-end certificate detailing exact principal and interest paid. This is the document required in case of section 24B to get the benefit of section 24B. Mandatory timeline in section 24B is, in this we have two rules: the inception rule, the construction rule. Inception rule dated from 1st April 1999. The inception rule is apply on those loans which are taken on 1st April 1999 or after that date. Loan prior to this date does not qualify for the current repair limit, that is inception rule. The loan which are taken prior from this date, these loans are not qualify for the inception rule. Construction rule. Duration is 5 years. If the loan is for construction, the property, if the loan, you have taken the loan for the construction purpose, then property has to be completed within 5 years from the end of the financial year. The loan will raised. The moment the property got completed, the loan was raised. Warning: the deduction can only be claimed starting from financial year the purchase of construction is complete. Okay. Additional deduction. Okay. Tax benefit under section 80E, deduction for first, this is basically deduction for first time home buyer. This is additional deduction up to 1.5 lakh on the interest rate, and it is affordable for housing loan. Stamp duty value with the principal limit applicable for specific sanction period. Deduction in section, as deduction as per section 24 is 2 lakh, and as per section 80C it's 1.50 lakh. The quantum of deduction is 50,000 for interest paid on home loan. Okay, so it is 50,000 from interest paid on home loan. Okay. What are the conditions necessary for claiming deduction under section 80E? To claim this specific tax benefit, the taxpayer must satisfy the following condition. These following conditions are: the deduction can be availed on home loan sanctioned between 1st April to 31st March financial year. This. Okay. The value of property for which the loan has been taken should be less than 50 lakh. The home loan amount should not be exceed 35 lakh. The tax benefits here can be claimed till the time repayment of loan continue. The deduction is only applicable to home loan paid from the house property. The property in question can either be self-occupied or non-self-occupied. I just said this. This is very important. Read this. Okay. These have some important points like value of property from home loan is 50 lakh and the loan amount should not be exceed 35 lakh. All these are very important points as for the deduction for 80E. Just remember one thing, section 80, the 80EE is for first time home buyer. Tax benefit to the first time home buyer. Okay. Okay. The deduction for interest paid on home loan is allowed under section 24B of the Income Tax Act. The maximum deduction for purchase construction is rupees 2 lakh per annum in the repair renewal, and the maximum deduction can be claimed up to 30,000. The additional deduction of rupees 50,000 in life for the first time home buyer under section 80E subject to certain condition. Okay, let's do some question. Read the question. Which of the following statements are correct regarding the tax benefit on home loan under section 24B of Income Tax Act? The tax deduction on home loan interest is available up to 2 lakh for self-acquired property. Yes, it is correct. The tax benefit under section 24B is applicable only if the loan was taken or after 1st April 2000. No, it is from 1st April 2000. It's not 2000, it's 1999, not 2000. So it's incorrect. The interest on home loan for self-acquired property can be claimed as deduction from salary, business income, or capital gain. Yeah, it's correct. If the property is self-occupied, the maximum interest deduction under section 24B is 1,50,000. No, it is 2 lakh, not 1,50,000. It's 2 lakh. The construction of property must be completed within 5 years from the date of loan is raised to claim the full tax benefits. Yes, correct. For property that is not self-occupied, the entire interest amount on home loan can be claimed as the tax deduction. Yes, correct. So, which are correct as per section 24B is 1, 3, 5, and 6. Option A is the right answer. Which of the following statement about tax benefit on home loan principal repayment under Section 80C are correct? The maximum tax deduction allowed under Section 80C from home loan principal repayment is 1,50,000. Yes, correct. The deduction under Section 80C is available only if the property is self-occupied. No, it is also in the case of let-out property. Not only self-occupied property, but also let-out property. So it's incorrect. Tax deduction on principal repayment can also be claimed for stamp duty and registration fees. Yes, correct. If the property for which tax benefit were available is sold within 5 years, the tax benefit will be reversed and deemed income. Yes, also correct. The tax deduction under Section 80C is applicable for the principal repayment during the construction period of property. It's incorrect. The tax deduction are not available during the construction period. It is available after the construction period, basically. Which of the following statement is correct? 1, 2, and 4 is correct. Sorry, 1, 3, and 4. That means option D is the right answer. Okay. Okay. Next question. Which the following statement are true regarding the tax benefit under Section 80E for the first time home buyer? Read the question and give me the answer. Deduction can be claimed for the home loan sanction only between 1st April to 31st March in the financial year. Yes, correct answer. Yes, correct statement basically. The maximum deduction under Section 80EE is 2 lakh for interest paid on home loan. It is not 2 lakh, it is 50,000 on interest paid on home loan. So it's incorrect. The home loan amount must be 50 lakh or less for less to claim the deduction. Yes, correct. The deduction can be claimed on home loan for properties that are self-occupied or rented out. Yes, correct. The tax benefit under Section 80 is available if the taxpayer already owes the another house on the date of loan sanction. Yeah, no, it's incorrect. Basically, it is incorrect because the deduction is only available if taxpayer does not owe any other house at the time of loan section. So if the taxpayer does not owe any other house at the time of loan section, then it will get the tax benefit. So which are basically the true statement? Statement 1, statement 4, statement 3 and 4. 1, 3 and 4, that is option A is the right answer. Okay, Mr. Arun paid 1,90,000 as a current year interest and 80,000 as per construction interest for self-occupied property. The construction was complete in financial year 2024 to 25. What will the maximum total interest deduction allowed by financial year 2024 and 25? We know that for self-acquired property, the total deduction as per section 24B is cannot exceed 2 lakh per annum. It cannot exceed 2 lakh per annum. So option C is the right answer. Read the question. Consider the following statement regarding the tax benefit under Section 80EE of Income Tax Act. The maximum deduction allowed under Section 80EE is 50,000 for interest paid on home loan. Yes, correct. The deduction is available only for the first time home buyer. Yes. The value of property should not exceed 60 lakh and the loan amount should not exceed 40 lakh. 40 lakh. The value of property should not exceed 50 lakh then and the loan amount should not exceed 35 lakh. As I told you, these are very important topics. Okay. The deduction under section 80E is available over and above the limits of section 24B and 80E. Yes, correct. 80C, sorry. The benefit because deduction under section 80E is over and above section 24B and section 80C. The benefit can be claimed only if the loan is sanctioned between 1st April and 31st March of the financial year in which the benefit is claimed. That's correct. So, which are basically the correct statement? 1, 2, 4, 5 are the correct statement. The option is the right answer. Which of the following investment or payments are included with the overall limit of 1,50,000 under section 80C along with the principal repayment of home loan? Give me the answer. Is it National Savings Certificate? Yes. Life Insurance Premium? Yes. Public Provident Fund? Yes. All of the above are under section 80C. Consider following statement regarding computation of actual rent and deduction related to the interest on loan of property. Actual rent. Actual rent means the rent received or receivable for the period during which the property is actually let out and vacancy period rent is not being deducted. Yes, correct. Unrealized rent can be deducted from the actual rent only if the tenancy is bona fide and the taxpayer has taken the reasonable steps to recover such rent. Yes. The interest on loan taken against the mortgagor of property for a business or personal need is fully deductible from the income of the relevant head. Yes, correct. Repayment of principal on loan taken for commercial property is eligible for deduction under section 80C. No, it's incorrect because principal repayment for commercial property or loan taken against the property is not eligible under section 80C. The benefits only apply to the home loan for residential or self-acquired property. So it's incorrect. Interest on unpaid interest is not deductible under any head of the income. It's correct. So which are the correct statement? We have to tell the correct statement. 1, 2, 3, and 5 are correct. That is option B is the right answer. Which the following set of condition must be met the qualified deduction under section 80E? Property value 50 lakhs, loan will property value will less than 50 lakhs, the loan amount will be equal to or less than 35 lakh. Loan sanction in financial year, no other house owned. And so after in the first option we got the answer, but please read the other options also. Property value is less than 60 lakh, loan amount equal to 40 lakh. The property is self-acquired if any, no. The property value less than 50 lakh, loan amount is equal to or less than 35 lakh. The multiple house allowed loan sanction anytime, no. Property value is less than 45 lakh, the loan amount is less than or equals to 25 lakh, the property must be rented, loan amount sanction after pencil. All these are like incorrect. Property value is less than 50 lakh, the loan amount is equal to or less than 35 lakh, the loan sanction in financial year, not other house owned. Okay. Do this question from PDF. Okay. Next unit, that is unit 29. Mortgage advice. What is mortgage advice? Mortgage advice basically a professional guidance provided by the bank officer, financial institution, or the loan consultant, basically loan provider. And it helps the borrower to choose the right type of loan, understand the cost and the risk in the loan, plan the repayment in effective way. Multiple dashboard estimating growth time. It is very important. They have three rules: Rule 72, Rule 115, Rule 144. Rule 72 is a simple method used to estimate the time required for investment to double at the fixed annual interest rate. In Rule 150, triple at the fixed interest rate, and in Rule 40, as per Rule 4144, as the required for investment to 4 times at the fixed interest rate. Basically, Rule 2072, how to calculate this? For example, interest is 10%, then 72 upon 10%, that will come around 7.2 years. In 7.2 years, the amount will get double. Same in case of 115 upon 10%, then in 11.5 years, the amount will get triple. And case of 114 upon 10%, that is 14.4, 14 point, in 14.4 years, the amount will get 4 times of the principal amount. Okay, this is the rule of estimating growth time. How to calculate the future value? Future value is well calculated. Future value is equals to present value into 1 plus r, that is rate of interest. It is number of period. So in this way, future value is calculated. So future value calculation required compounding every multiple the base of 1 plus r. Okay, what we meant by ordinary annuity and annuity due. Ordinary annuity is basically payment made at the end of each period, basically. And in annuity, basically, in annuity due, the payment made at the beginning of each period. So it is made at the end of each period. It is made at the beginning of each period. Okay. Example of it is home loan, EMI. Example of annuity due is basically uh, rent payment, loan payment, lease payment. All these are example of annuity due. Features of ordinary annuity is interest is earned after payment period begins. Most loan EMI follow ordinary annuity. Okay. Key point of annuity due: payment happen at the beginning of each period. What is the formula of calculating ordinary annuity? Formula is PMT into 1 plus r ki power n minus 1 upon r. It is the formula of calculating an annual annuity. And what is the formula of calculating annuity due? It is same as ordinary annuity, but it's just that we will multiply this ordinary annuity with 1 plus r. This extra 1 plus r factor reflects one extra period for compounding as it paid at the beginning of tenure. Okay, as it paid beginning of each period. So that why this 1 plus r is extra for one extra period of compounding. Annuity due is impact on generally generates higher future value and present value, while ordinary annuity is generate lower future value and present value related to annuity due. Okay. What is capital gain? Capital gain is the gain. It is basically capital gain is the difference between selling price minus purchase cost. Capital gain is a gain. It's a total gain. So basically profit we earn on selling the property more than the price at what price we bought it. For example, I have given the example. I bought a watch for 20,000, but later on I sold that watch for 25,000. So 5,000 is my capital gain. It includes capital assets, property, house or land, shared security, mutual fund, gold, jewelry. All these are included in the capital gain. Agricultural land is the exception of the capital gain. Agricultural land located within the jurisdiction of municipality with a population exceeding 1 lakh is excluded from the definition of capital gain. Only land outside the municipality is qualified for the capital gain. As I've already told you, there are two types of capital gain: short-term capital gain and long-term capital gain. Short-term capital gain holding period in case of share and equity fund is less than or equal to 12 months, but in case of this long term it is more than 12 months. In case of holding period of immovable property, in short term capital gain is more equal to or less than 24 months, where in case of long term it is more than 24 months. Other assets, other assets are like their holding period is equal to or less than 36 months. In case of long term it's more than 36 months. So this is the holding period of short term and long term capital gain. Tax treatment: in case of short term it is 15% tax equity share, and in the long term it is 10% tax above 1 lakh, and property and other it will be 20% with induction benefit. In case of other asset in short term, capital gain is taxed as per normal income tax slab. Loan calculator and loan amortization schedule. Loan calculator is basically is a tool to use to calculate the EMI, total interest payable, total repayment amount, to help the borrower to plan their loan before taking it. So how will they repay the loan in future? That's why its loan calculator is there. EMI formula: P into R into 1 plus R ki power n upon 1 plus R ki power n minus 1. P is the principal amount, that is loan amount, R is interest rate, N is number of month. Okay, let's do some question. Okay, which of the following statement about the mortgage advice profession and development of home information pack are correct? Statement 1: the mortgage advice profession in India is regulated with specific code of conduct and entry barriers. It's incorrect, because a mortgage advice profession in India is not regulated. It is not regulated. In US, mortgage brokers must be licensed to carry out the mortgage broking activities. Yes. Home information packs in UK were introduced to provide essential information to property buyer and seller. Yes, correct. Energy performance certificate in UK are optional document in home information pack. It's correct. Home condition report in UK are mandatory for all properties being sold. No, home condition reports are optional, not mandatory. So it's incorrect. Home information packs are applicable in India with plans to introduce them in 2025. It's incorrect. Home information packs are not applicable in India. Home condition report are not applicable in UK, are not mandatory in UK. Home implication packs are not applicable in India. So it's also incorrect. So we have to tell the correct statement, which are correct statement 2 and 3 are the 2, 3 and 4 are the correct statement. That is option B is the right answer. The cost inflation index is notified by Reserve Bank of India, Security Exchange Board of India, Central Government, Income Tax Appellate Tribunal. The cost inflation index is notified by central government. Okay. Consider the following statement regarding the request compounding of interest and rules 72, 115, 144. As the frequency of compounding increase, the effective amount amount of interest and also increase, though the rate of increase diminished with the higher frequency. It's correct answer. When the interest is compounded annually at 6% on 10,000, the final amount after 1 year will be 10,600, whereas with the monthly compounded at the same rate, the final amount will be approximately 10,616. Correct. The rule of 2072 provides a simple way to estimate how long it will take for the money to double without using financial calculator or logarithm computation. Yes, correct. A 6% annual interest, the rule of 72 implies it will take about 10 years for money to double. It's like 72 divided by 6, it will 12, not 10. So it will take 12 years for money to get double. So it's incorrect. If rule 1 and 5 and 1 and 4 help to estimate the time of investment to almost triple and quadruple respectively when they divided by the applicant's rate of interest, is correct. These questions are like some kind of tricky question in which you should calculate the things that 72 divided by 6, whether it's 10 or 12. Not just reading it, then money will get double. You will take the right answer. No, as they have given the option all of the above. So these questions are kind of tricky question. I'm again saying this thing again and again. Read the question properly. Which of the following combination of statement regarding capital gain taxation is correct? Read the question. A capital assets, whether movable or immovable, tangible or intangible, is subject to capital gain tax when transferred. Yes. Agricultural land in India located with the jurisdiction of municipality with a population exceeding 1 lakh is considered as a capital asset. No, it's incorrect. Because agricultural land with the jurisdiction of municipality with the population exceeding 1 lakh exclude from the definition of capital assets. It is only agricultural land outside the municipal area is qualified for the capital asset. So the agricultural land which is located within the jurisdiction of municipality, it is not under the capital asset. So it is incorrect. The period of holding share listed on recognized stock exchange in India to qualify as a short-term capital asset in 36 months. It's incorrect. It is 12 months, not 36 months. It is 12. If capital asset is transferred by way of gift, the capital gain tax is not applicable on the transfer, but receipt of the gift must be paid at the tax when the asset is subsequently sold. It's incorrect. If capital asset is gifted, then no capital gain arise in the hand of the donor at the time of gifting. The receipt only pays capital gain tax if, like, if when they sell the asset, not the immediately. So it is not done immediately when they sell it. It is happened when. So it's incorrect. The cost of acquisition of gift capital asset is the cost to previous owner, and the holding period is to calculate it from the date of acquiring by the previous owner. It's correct. Long-term capital gain on the sale of immovable property is taxed at the higher rate than the short-term capital. It's incorrect because long-term capital gain on the sale of immovable property is not taxed as higher as the short-term capital gain. In fact, the long-term capital gain generally benefits from lower tax due to indexation benefits. So it's incorrect. We have to tell the incorrect statement. So which is the correct, which is the incorrect statement? 2, 3, 4, 6. That is option C is the right answer. If we got missed to read this incorrect word, then we will take the answer 1, 5. Hopefully 1 and 5 are not in the answer. So that's why I'm saying read the question carefully. Consider the following statement regarding the cost inflation index. Read the question. Cost inflation index is used to adjust the cost of acquisition of capital asset for inflation. Yes. The base year of indexation was shifted from 1982 to 2021 to 22. No, it is from it is shifted from 1981 to 82 to 2001 to 2002. It is basically 2001 to 2002. Okay. The index cost of acquisition can be calculated using the formula index cost of acquisition is equals to cost of acquisition minus cost of inflation of index of year of transfer upon cost of inflation index of year of acquisition. It's correct. So which above statement are correct? Option statement 1 and 3 are correct. That is option C is the right answer. Read the following statement carefully and choose the correct option. Under section 54, exemption is available for long-term capital gain arising on transfer of residential house property. Yeah, it's correct. As per section 54B, allow exemption for long-term or short-term capital gain arising on transfer of agricultural land, and the gain must be reinvested in purchasing the agricultural land. Is correct. Section 54EC provides the exemption for long-term capital gain arising from the transfer of capital asset, provided the gain in reinvestment in the bond issued by NHAI or Rural Electrification Corporation Limited. Yes, correct. Under Section 54EE, long-term capital gain arising from the transfer of any capital asset can be reinvested in the unit for specific fund to the financial startup. Yes, correct. Exemption under Section 54F is available for long-term capital gain arising from transfer of capital asset other than the residential house property. Yes, correct. To claim the exemption under Section 54G, the gain must be reinvested in acquiring building plants, or machinery to shift the industry undertaking from an urban area to rural areas. Correct. Section 54GB provide an exemption for long-term capital gain arising from transfer of residential property, providing the gain in reinvested is subscribing to the equity share of a eligible company. It's correct. So which are the correct statement? All the statement correct. That means option D is the right answer. All the statements are correct. Each statement are correct as this is right. The section 54, 54B, 54C, 54E, 54F, 54G, 54GB of Income Tax Act. Go through these section once. Okay. Next question. Which of the following statement are true regarding section 54 and taxation of long-term capital gain? To claim exemption under section 54, the taxpayer must purchase or conduct or construct a new house within 1 year before or 2 years after the transfer date. It's correct. If the capital gain is not utilized by return filing date, it must be deposited in non-taxable account. It's incorrect because the utilization capital gain should be deposited in the capital gain deposit account scheme, not on the non-taxable account. Long-term capital gain on the transfer of property are taxable at a flat rate of 20%. It's correct. A resident individual can adjust long-term capital gain against the basic exemption limit before adjusting other income. It's incorrect because a resident individual can only adjust the exemption limit against long-term capital gain after adjusting other income. It is before adjusting other income, no, after. Okay. A surcharge of 10% is applicable on long-term capital gain if the total income exceeds 10 lakhs. It's correct. So we have to tell the true statement. So which are true statement? 1, 3 and 5. 1, 3 and 5. That means option is the right answer. Attend this question from PDF. Under section 54 of Income Tax Act, if the taxpayer wanted to claim exemption on capital gain from the sale of house with in what time the frame must the new house be purchased? Give me the answer. In what time frame the new house will be purchased? Whether it's within 6 months before or 1 year after transfer of old house, within 1 year before or 2 years after transferring the whole house, within 2 years before or 1 year after transferring the whole house, or within 1 year before or 6 months after transferring the or transfer of old house. So under section 54, it is within 1 year before or 2 years after transferring of the old house. Within 1 year or 2 years after transferring the old house. MS Kapoor invested sum of money in fixed deposit for 5 years at the interest rate of 9% per annum. At the end of 5 years, the maturity value of investment was 1,58,000. What is the amount invested at the beginning of present value of the investment? So here future value is 1,58,000. Okay, and the rate of interest is 9%. That will 0.09. Number of month is 5 years. 5 years is somewhat we can say okay. Okay. And we will multiply this with this 0.09. No. Will plus 1 in this, then we multiply with like 1.09. It will, when we calculate, it will come 1.53862. Then for present value, we will like future value, that is 1,58,000 upon this 1.53862. It will come 1,02,650. Okay, this is the whole process. Last unit of RBWM, valuation of real property. Okay, so before it, if anyone having any doubt, please let me know in the chat box. What is basically valuation of real property? Valuation of real property basically means estimating the market value of land, property or building or of immovable property. Why valuation of property is important? It is important in home loan, mortgage lending, taxation, insurance. Bank conduct property valuation before granting housing or mortgage loan. Okay, that's why valuation of real property is important. So they have like in the valuation of real property, there are various methods. These methods are valuation method of agricultural land, It is can be calculated by two ways: income capitalization method or sales statistics method. Income capitalization method basically value based on income generated from the farming. So it is calculated with the formula land value upon net annual income divided by capitalization rate. So capitalization value basically net income upon net income into year of purchase. Year of purchase is 1 upon interest rate. So if we put the year of purchase here, the net income into year of purchase will be capital value. That is income capitalization method. Here the variable, here the net income is equal to rent minus taxes, maintenance, insurance. So net income is basically rent minus taxes, maintenance, insurance. What is this statistics method? Sales statistics method is a property valuation method in which basically value of property is determining by using statistic analysis of recent sale transaction of a similar property. For example, I want to buy a property. A particular farmer want to buy a land here in this area. He want to buy this land. So through this statistic method, this land has been sold. For example, this land has been sold. So through this statistical method, he will analyze the recent sale transaction, that at what value the recent sale is being done, so that he can put the assumption of the property value. Okay, कि कितने की property होगी actually ये, कि अगर इतने की sold हुई है, for that example that property is sold for 20 lakhs. So is it worth it? Firstly, then he will make the mind according to that key. If that particular property is sold for 20 lakhs, then my valuation of my property will be around it only. Okay, so this is basically sales static method in which the value can be. Okay, okay. So there are more method: development method or cost method. Development method basically used when the agricultural land has future conversion or development potential. This is also for agricultural land development method and cost method. It is where example land near urban areas or highway have like the development with basically land, we buy the land where the in future there will be a future development, like land near highways or front and to like near the urban areas, it will like they will develop in future. So open land or land building possession hidden development rendered redevelopment potential project increase in capital value cost of modification used when the agricultural land has future conversion or development potential. Cost method is basically calculating value considering the fencing, farm infrastructure, land improvement cost. All these will come and calculate in the cost method. Estimating the land value plus the current depreciating reproduction of cost of building. Land value plus all the facilities in fencing, farm infrastructure, all the including it is the cost method. Balance sheet capitalization method. Basically, balance sheet method is the valuation method in which the value of business, like value of land, is being calculated in the determined basis of specialized building. Balancing sheet capital method is used in case of specialized building like cinemas, hotel, bar. Their prerequisites must be going concern with the proper licensing. There are steps in balance sheet method. They have are step 1 gross income, then less expense, then average net profit, then capitalization. Assess the occupancy rate, lease the space amenities. Then step 2 is direct overhead taxes management costs. Step 3 average net profit class calculate over the recent year. Step 4, capitalization, apply appropriate interest rate reflecting the business risk. This is how basically capitalization balance sheet capitalization method is being used. Valuer must include intangible assets like goodwill, monopoly alongside the physical premises. Okay. Okay. What is sinking fund? Sinking fund is basically fund created by setting aside money regularly to repay the debt or replace an asset in future. Basically, it helps to accumulate the fixed amount over a period through a periodic contribution. So it basically helps to determine the fixed amount over a long period and through the periodic contribution. Like for example, a property yielding 8 lakh annually with 10% income interest rate and 5% capital redemption over 25 years. The yearly profit is 8.227. The capital value will be 8 lakh into 8.87, that is 66 lakh 16,600. 60 lakh 60 lakh 16,000. This is the purpose of sinking fund, to recover original capital of property at end of its useful life, ensuring fund replacement and rebuilding. The amount is calculated based on the compound interest over the property lifespan using sinking fund factor from the valuation table. What is mortgage and reverse mortgage? Mortgage is basically a loan in which property is kept as a security for repayment of loan. Okay. It is commonly used for home purchase, construction, property renovation. Like it is like borrowers repay through EMI and bank can take possession on default. So mortgage is basically a loan which basically mortgages we take the loan and put the property with the customer with the bank as a security for repayment of loan. Bank take the property as a security for repayment of loan. The moment we repay the loan amount, the bank will return the property to us. Reverse mortgage. Reverse mortgage is a scheme where senior citizen mortgage their house to the bank. It means the bank they will receive the periodic payment from the bank. In mortgage, basically the property is kept by the bank and the borrower will pay the loan amount. But in reverse mortgage, it is for senior citizen where senior citizen keep his property for mortgage to the bank and receive periodic payment on that property. Basically, it is designed to retain the person. It is basically designed for the retired person. No regular EMI payment by the borrower. Loan recover after the death or sale of the property. Okay. Silent features of reverse mortgage loan available to senior citizen above 60 years. No payment, non repayment of principal interest required during borrower's lifetime. Offered primary lending institution like scheduled banks and housing finance company registered with NHB. Loan amount depends on borrower's age, property value. Just a second. Read this out. Maximum monthly payment is 50,000. Lump sum is capital 50%. Payment monthly loan tenure is 20 years. Property line is treated as capital gain tax event of the borrower. Read the silent feature of this reverse mortgage loan. What is basically belting method? This is important. Belting method is basically a land valuation method used mainly for commercial properties located on the main road. As we know, property near the main road have like are of higher value, are like good value than the property which are far away from the main road. So this is basically belting method, in which the land is divided into different belt based on their distance from the main road, because front portion have higher value than the rear portion, that is the portion which is not near to the road. So this is a belting method. Yes, Hina, if you want to buy the property, we prefer to buy the property near the road, because near the road property like usually get development quite easily and they are beneficial for investment purpose. So this is a belting method of land valuation, and it like front properties have maximum value. Value decrease if the distance from the road increase. Other methods such as rent capitalization method or comparative method do not directly focus on physical dimension of the land. Comparative method. Comparative method basically a property of value is determining by comparing it with the similar property recently sold in same locality. This is comparing by comparing the property. We are evaluating the value of the existing property. This is a comparative method. Let's do some questions quickly. Consider the following statement regarding the concept of valuation. Give me the answer. Voice is now voice is fine. Am I audible properly to everyone? Okay. Yeah.